Like the idea of having great businesses work hard for you so you don't have to? Looking for big, safe, growing dividends that you can live off of? Want to know my top 5 stocks for January 2023? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal 6-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. 2022 is done and over. Woo! What a year, right? Well, I must say, I actually enjoyed it. Look, I'm young and still actively buying high quality dividend growth stocks. Naturally, as with everything else that I'm buying, I prefer when those stocks are cheaper, not more expensive. All else equal, price and yield are inversely correlated. So lower prices result in higher yields, which piles up my dividend income that much faster. That is why you must strike when volatility takes hold and sends stocks lower. I always see short-term volatility as a long-term opportunity. And that perspective helped me to go from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. All that said, it's a big market and some ideas are better than others. Focusing on the very best long-term ideas right now is what this video is all about. Today, I want to tell you my top 5 dividend growth stocks for January 2023. Ready? Let's dig in. My first dividend growth stock pick for January 2023 is Corning Incorporated, stock ticker GLW. Corning is a multinational material sciences company. This is such an under-the-radar company. Despite the lack of attention though, it's at the forefront of various technologies. Not only that, but its products are both critical and integral. How about optical fiber for internet access, glass for smartphones, and specialty materials for advanced R&D processes? A lot of the tech we all love and use every single day doesn't really work without Corning's products. Now, Corning won't knock you dead with its growth. Instead, it just steadily advances. Revenue has grown at a compound annual rate of 6.5% over the last decade, while earnings per share has compounded at an annual rate of 7.4% over that period. Steady business growth is what's fueled steady dividend growth. Corning has increased its dividend for 12 consecutive years. The 10-year dividend growth rate of 13.4% does outpace EPS growth by quite a bit. However, Corning is expected to produce much more bottom line growth over the next few years, which is what could allow the company to continue with its double-digit dividend growth pattern. You get a 3.4% yield to go along with that. And this yield, by the way, is 80 basis points higher than its own 5-year average. With what is basically a perfect payout ratio of 50.2%, Corning deftly balances dividends with retaining earnings. Good stuff. I think this name is significantly undervalued right now. Even in a depressed market, this stock's price-earnings ratio of 14.8 is noticeably low. Does it deserve a super high earnings multiple? Should it command a PE ratio of 30? No, but that's not where we're at. We're in very undemanding territory here. Our recent analysis and valuation video on the business shows why Corning could be worth $39.51 per share. This looks like an above average business with an above average yield being sold for a below average valuation. It should definitely be on any dividend growth investor's radar. My second dividend growth stock pick for January 2023 is Ingredion Inc., stock ticker INGR. Ingredion is a leading worldwide ingredients solutions provider. So what does this company do? Well, Ingredion turns raw materials like grains, fruits, and vegetables into value-added ingredients and biomaterials for various industries. It also provides products for the animal feed and corn oil markets. Some examples of their products include industrial starches, high fructose corn syrup, dextrose, and refined corn oil. Maybe that sounds complicated, but it's really not. Simply put, Ingredion is supplying the world with simple yet critical ingredients, and the company is making a lot of money by doing so, more and more money in fact. Now, the compound annual growth rate of 0.7% for revenue and 2.2% for earnings per share respectively over the last decade isn't super impressive, but it's more of a time frame issue than a business issue. To that point, Ingredion is expected to compound its earnings per share at a 10% annual rate over the next 3 years. An acceleration in bottom line growth supports continued dividend growth. Already, the dividend, which has been increased for 12 consecutive years, sports a 10-year dividend growth rate of 15.8%. So you can see how dedicated Ingredion has been to rewarding shareholders with large dividend raises, despite the fact that earnings per share growth has not always been quite enough for that. With EPS growth expected to accelerate back into the double-digit range, shareholders likely have many more sizable dividend raises to look forward to. That belief is partially based on the fact that the payout ratio is only 39.3% based on midpoint guidance for this fiscal year's adjusted earnings per share. Meantime, you're getting a nice 2.9% yield to start with. This dividend growth stock could be just the ingredient that your portfolio needs right now. I say that because this ingredients company looks undervalued based on just about every metric you can possibly look at. A great example of that, the PE ratio of 14.9. As we have with Corning, it's yet another name with an earnings multiple that's below 15. Also, as we have with Corning, it's yet another business with growth expected to accelerate. Compressed valuation with accelerating growth, that is a nice combination for explosive upside potential. We put out a full analysis and valuation video on Ingredion only weeks ago, showing why shares have an estimated intrinsic value of $118.37 each. With the stock currently priced below $100, I'd argue that we've got a good deal here. Don't forget about Ingredion. My third dividend growth stock pick for January 2023 is Medtronic PLC, stock ticker MDT. Medtronic is a global developer and manufacturer of medical devices for chronic diseases. This is a world-class business in a part of the economy experiencing secular growth, and because medical devices aren't something you're going to negotiate over when a surgery is necessary, Medtronic benefits from constant demand, rising demand, and an elastic demand. That is an amazing trifecta. In spite of it all though, this stock has been in the doldrums recently. What gives? Well, the company has been dealing with both supply shocks and demand shocks. The global supply chain has limited the company's ability to bring new product to market. At the same time, the pandemic has put elective surgeries on hold. Even with the headwinds, Medtronic still compounded its revenue at an annual rate of 7.5% and its earnings per share at an annual rate of 5.7% over the last decade. Medtronic also continues to reliably increase its dividend through thick and thin. Indeed, Medtronic has increased its dividend for 45 consecutive years. That's longer than I've been alive for, and I'm no spring chicken anymore. The 10-year dividend growth rate of 10.3% pairs very nicely with the stock's current yield of 3.5%. Medtronic's payout ratio of 51.6% based on midpoint guidance for this fiscal year's adjusted earnings per share gives them plenty of leeway in terms of paying and raising that dividend. This is a vaunted dividend aristocrat that's clearly proven its commitment to the dividend. This might be one of the best deals in the entire market. Medtronic is almost never this cheap. I've been investing for more than a decade now, and I've never seen it like this before. Take the price to cash flow ratio, for instance. It's sitting at 16.5. Its 5-year average, 21.4. That is a crazy spread. Also, that aforementioned 3.5% yield, yeah, that's 130 basis points higher than its own 5-year average. Medtronic is starting to flirt with high yield territory, which is unheard of for this dividend aristocrat. Our recent full analysis and valuation video on Medtronic, which went live only days ago, made a compelling case as to why the business could be worth almost $111 per share. The stock is currently priced at $77.50. This is a great business being thrown in the bargain bin. Consider grabbing cheap shares while you still can. My fourth dividend growth stock pick for January 2023 is Microsoft Corp, stock ticker MSFT. Microsoft is a multinational technology corporation. Boy, what doesn't Microsoft do? The company's products and services include Windows operating software, Azure Intelligent Cloud, Office software, the Xbox gaming system, LinkedIn, and Surface computers and tablets. Not only do they offer so much, but they excel at all of it. it, no pun intended. That's why the company's market cap is sitting at $1.8 trillion. You don't get to that kind of size and make that kind of money without doing many, many things extremely well. Speaking of money, revenue has compounded at an annual rate of 11% over the last decade, while earnings per share has a compound annual growth rate of 15.8% over that period. Double-digit EPS growth, double-digit dividend growth. The dividend, which has been increased for 20 consecutive years, has a 10-year dividend growth rate of 12%. Surprisingly, this is the rare double-digit dividend growth rate that's actually somewhat disappointing, as Microsoft could have afforded to be a bit more generous with the dividend raises. Either way, hard to complain about that kind of dividend growth. However, the stock's yield, which is 1.1%, does leave some room for complaining, but this is really more of a compounder than an income play, and with the payout ratio at only 29.3%, I see this dividend compounding at a high rate for a long time to come. This is one of the highest quality dividend growth stocks in the world, and right now could be one of the rare times in which it's buyable. I rarely include Microsoft in a list like this only because it rarely looks buyable, but I think it's in one such rare buyable zone right now. We have disconnects in the valuation metrics across the board, with almost every single basic metric lower than its respective recent historical average. The price earnings ratio of 25.7 is a great example of the disconnect, with that being well off of its own 5-year average of 36.9. Yeah, that's a high 5-year average. Like I said, Microsoft rarely looks buyable, but it does now for the first time in a long time. We'll have a full analysis and valuation video coming out soon on Microsoft, so keep an eye out for that. Meantime, if you don't already have as much Microsoft stock as you'd like to have, consider upping that exposure here with shares trading for less than $240 each. My fifth dividend growth stock pick for January 2023 is Tyson Foods Inc., stock ticker TSN. Tyson Foods is one of the world's largest processors and marketers of chicken, beef, and pork. Tough to go wrong with Tyson Foods over the long run, guys. After all, betting on Tyson Foods is akin to betting on the continued and rising demand for meat among human beings. And since we've all got to eat, it's not too much of a stretch to make that bet. The world's population is growing, which means more mouths to feed, and we're also becoming wealthier on average, which means more demand for proteins. All of that bodes well for Tyson Foods, and it should help them to build on what they've already been doing. To that point, the company has grown its revenue at a compound annual rate of 5% and its earnings per share at a compound annual rate of 17.3% over the last decade. Some people don't like to eat meat, and that's fine, but nobody hates dividends. Tyson Foods has raised its dividend for 12 consecutive years. The 10-year dividend growth rate is an astounding 27.7%, but more recent dividend raises have been in the mid-single digit range. However, the stock's yield of 3.1% compensates you for that slowing dividend growth, in my opinion, plus the payout ratio is a super low 21.5%. That gives Tyson Foods the kind of room they need to continue increasing the dividend in a challenging near-term environment where margins are expected to compress. Honestly, Tyson Foods isn't my favorite business, but this valuation makes me like it a lot more than I usually do. This stock looks cheap from just about every angle. The price earnings ratio is below 7. Yes, below 7. I've gotten the memo about a near-term decrease in earnings. I know, I get it, but the market has priced in a pretty severe decline in profitability already. Too much, I'd argue. We will soon put out a video going over operations and the valuation, showing why this business has an estimated fair value of $81.83 per share. In fact, that video may already be live by the time you're watching this video. As I shoot this footage, Tyson Foods shares are trading hands for about $61 a piece. Very good business. Great valuation. Make sure it's on your radar. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these top 5 dividend growth stocks for January 2023. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.